Right now, most investors are watching the wrong signals. Attention seems to be fixed on day-to-day volatility, on headlines that have, for the most part, already been priced in. But the most significant risks, they don't announce themselves. A decision is forming, not yet public, not yet leaked, that has the potential to reprice key assets almost instantly. There won't be a warning, there won't be a gradual adjustment, just a sudden, definitive shift. And by the time it's obvious, the opportunity to position for it will have passed.
If you just look at the surface, gold appears quite stable, holding a tight range. Now, to the consensus view, this is reassuring. It seems to signal an absence of immediate crisis, a state of equilibrium where systemic risks are contained. This gets interpreted not as tension, but as resolution. It suggests the system has absorbed prior shocks and found its balance. And this right here is the first layer of the illusion. Then you have silver. As the more volatile of the monetary metals, it appears weak. Its price action suggests poor industrial demand, a kind of risk-off sentiment where capital sees no urgent reason to seek its protection. By all conventional metrics, it looks broken. And this weakness is seen as just another confirmation of a non-inflationary, low-growth world, a narrative that further suppresses any perception of imminent risk.
And finally, there is India, a truly critical node in the global economy that, for many, barely registers as a primary source of risk. Its markets are often viewed through a lens of domestic growth, of resilience, really a story of structural strength. But this view overlooks a critical vulnerability. It is this combination, this collective quiet across key indicators, that is creating the very conditions for a shock. So this brings us to the central thesis of our analysis. The current calm in the market is not a sign of safety. It is, in fact, the primary source of vulnerability. Let's deconstruct this complacency to really understand the structure of the risk it's concealing. On one side, you have the market's prevailing assumption that the trade shock is over, that tariffs are priced in, and that the period of volatility has passed. This is a very dangerous perception. The reality, on the other side, is that the risk hasn't disappeared at all. It has simply gone dormant. Critical pressure points remain just beneath the surface. And in an environment like this, calm isn't a buffer against risk. Calm is the exposure. This is a fundamental truth of market dynamics, isn't it? The greatest dislocations, they don't emerge from environments of high alert and widespread fear. They are born from periods of extended quiet, from those moments when the majority of participants conclude that all the major risks are known and accounted for. And that is precisely the environment we find ourselves in today. So let's examine the nature of this dormant risk. This isn't about analyzing what has already happened, but about understanding the pattern of execution for these high-impact policy moves. Historically, the most significant market-moving decisions are not telegraphed. They are implemented suddenly to maximize their effect. They are, by their very nature, designed for surprise. Just consider the conditions that preceded past shocks of this nature. They were consistently characterized by quiet markets, where positioning is uniform and hedges are cheap to overwhelm. They occurred when implied volatility was low, signaling that options markets were not pricing in any real deviation from the status quo, and they were executed when positioning, both institutional and retail, was deeply complacent. These are not just historical observations. These are the preferred conditions for a strategic policy shift that's designed for maximum leverage. Let's be absolutely clear on this point. A quiet market is not a safe market. A quiet market is one where hedges have been unwound, where risk premiums have been compressed to near zero, and where participants are least prepared for a change in the state of the world. This lack of preparation, this collective calm, is not just a financial state but a psychological one. It is the system's greatest exposure. Now, if a dormant trade shock is the risk, we must then identify the vector through which it's most likely to be applied. Our analysis indicates that this pressure point is India. The country stands at a unique intersection of economic, strategic, and symbolic vulnerabilities. So, why India? Well, because it combines three distinct sensitivities. First, it's a critical, yet somewhat fragile, link in global supply chains, where even a small disruption can create nonlinear effects across the entire system. Second, it is highly dependent on commodity imports, especially for energy, which makes it acutely sensitive to price and currency shocks. And third, its growth model remains quite sensitive to external demand. This combination makes it a uniquely efficient target for applying strategic pressure. You see, in the calculus of trade policy, leverage isn't always about targeting the largest economic counterparty. Often, it's about targeting the most visible one, the one whose response will send the clearest symbolic message to the rest of the global system. Visibility, in this context, creates leverage. And here is where the critical divergence lies. Markets tend to view India through the lens of its large, resilient domestic economy, and they conclude that its exposure is manageable. Policy, however, particularly policy focused on geopolitical leverage, may view India through a very different lens, as a negotiable partner, a symbolic target, and an ideal pressure point. It is in the gap between these two perceptions that the potential for a repricing event emerges. Having identified the dormant risk and the likely pressure point, we now turn to the markets that tend to signal this kind of stress the earliest. We have to look away from the noise of equities and toward the quiet signals that are emanating from the precious metals markets. Gold's current stability is being widely misunderstood. It is not a signal of confidence. It is a signal of preparation. You see, gold doesn't react to headlines. It moves in anticipation of the conditions that create those headlines. Right now, sophisticated capital, entities like central banks, sovereign funds with mandates to preserve capital across regimes, they aren't panic buying gold. They are quietly hedging, establishing positions before the risk becomes obvious. Before every major repricing, gold stops falling first. And that is what we are seeing now. Silver's behavior is different, and it provides a more granular signal. Its current weakness is a classic sign of what we call stress without direction. The metal absorbs the ambient, unquantifiable doubt in the system before a clear catalyst emerges. This early weakness is often mistaken for a fundamental breakdown, but it is actually the precursor to a very violent move once a direction is finally established. When that policy direction arrives, silver doesn't simply follow gold. It outpaces it. Because its market is smaller and less liquid, its price reprices almost vertically when conviction returns. The key takeaway here is this. By the time silver begins its sharp rebound, the window for protective positioning is already closed. It moves first, and it moves fastest. This brings all our points together into the central challenge for investors, the asymmetry of repricing. And understanding this asymmetry is absolutely critical to navigating the environment ahead. Waiting for confirmation of the risk is, structurally, a flawed strategy. A major shock doesn't hit all asset classes at once. It propagates through the system in stages. First, you have the leak. The earliest signals appear in the most sensitive instruments, visible really only to specialists, things like commodities, currency hedges, shipping costs. Next comes the flow. The shock moves into the bond market and broader credit as institutional players begin to react. It's only in the final stage that we see the impact on headline inflation and finally on equities, which is when the public and the media catch on. The majority of investors are positioned to watch for the impact. By then, the real repricing is already over. Given this propagation process, waiting for the event to be confirmed by mainstream news or a sell-off in the S&P 500 is the most expensive strategy an investor can pursue. The downside move happens quickly, while establishing the necessary upside protection requires positioning well in advance of the event. This is the core asymmetry.
Let us be unambiguous on this. Confirmation of this risk will not be a research report or a news conference. Confirmation will be a price on a screen, a price that has already moved, a gap down that cannot be traded. The confirmation arrives only after the financial repricing is complete.
So the analysis presented here is not a specific forecast of a date or a time. It's an assessment of conditions and probabilities. It highlights a structural vulnerability in market positioning. The markets look calm, and that, in and of itself, is the warning. The feeling of safety is pervasive, and when everyone feels prepared for the future, it is often because they are positioned for a past that is about to end.